Okay, now we'll go through some of the more complicated topics, and we'll start with equity accounted entries. So AASB 112, to put it into context, says that when you recognize a deferred tax asset or liability, you need to refer to and follow the original accounting entry, which gave rise to the temporary difference. And you will note that you have certain accounting entries which you post against the equity section of your balance sheet. And some of the examples are you might revalue an asset, or when you apply a new accounting policy or accounting standard, you might make an adjustment to your opening balances against your retained earnings. And two common ones which I also see includes hedge, when you apply hedge accounting or you are accounting for defined benefit plans. So let's look at an example to clarify that adjustment. And let's look at a situation where you revalue an asset. So let's say you have a plant. You have a plant equipment which costs 10,000. So the tax base equals 10,000. And let's say, for simplicity, you immediately revalue it by $6,000. That revaluation does not change the tax base of an asset. Therefore, you have a carrying amount of 16,000 and a tax base of 10,000, giving rise to a taxable temporary difference of $6,000, which means that you have a deferred tax liability of 6,000 times 30% of 1,800. So you know that you're going to credit your deferred tax liability by 1,800. The question is, what do you debit? Which account do you debit? So in order to work out which account you need to debit, you need to refer to the original accounting entry. So to revalue the asset, you debited the asset by $6,000 and you credit the asset revaluation reserve. So following the original entry, when you credit your deferred tax liability, you need to debit the asset revaluation account by the 1,800. Now, to give you a further example, if you depreciate that plant, right? If you depreciate that equipment, over time, you'll find that your deferred tax liability would reduce. So you need to debit the deferred tax liability balance. The question is, which account do you credit? The answer is you need to credit your income tax or deferred tax expense account. Why? Because accounting depreciation is going against the profit and loss statement. So what that means is whatever is sitting in your asset revaluation reserves stays there. And then when you dispose of that asset, you simply move the entire revaluation reserve to the capital profits reserve or the retained profits